welcome back to this week's market update. This is Kelly coming to you from Synergy Asset Management. Today is Good Friday, April 7th, 2023. We got the markets closed, but we're still giving you another week of updates here, so let's get right into it. So with the shortened week this week, we had pretty muted market moves, but all eyes were on the jobs data. So initial claims came out on Thursday, as it always does, and then more importantly, while the market was closed on this Good Friday, we saw the jobs report come out for the month of March on Friday. So as of Thursday, April 6th, we had the Dow Jones fall about 0.34%, the NASDAQ fall about 0.47%, and the S&P 500 fall about 0.83%, while the 10-year U.S. Treasury yield fell 3.8% on the week. Before we dive into the jobs report and what that means for the economy, where we're at in the employment markets, I wanted to talk a little bit about the ISM Manufacturing and Services Indexes that we also got this week. So for the manufacturing index, we got a weaker month again on this kind of downward sloping trend over the last few months in manufacturing activity. And we had that index come in at 46.3 right there, lower than expectations of 47.4. So definitely an increasingly bearish manufacturing landscape that we're looking at here, and this data point also marks the fifth contractionary reading as the index has fallen below 50% since November of 2022. Similarly, the March ISM Services Index came in lower than expected at 51.2%. Here, that was about 3.9% lower than February's 55.1% reading, and it was also a lot lower than estimates of about 54.3%. So this lower data point is bringing mixed sentiment in that it's hopeful against the fight against inflation, that stickier services inflation that the Fed is really trying to tamper down on. But again, this is still bearish for the overall economy as this is moving towards a contractionary period. Moving into the employment data of this week, I wanted to just give a little bit more context of where we are at in this cycle and where we typically are before a recession. So here you can see throughout this chart, since the 1950s, the unemployment rate obviously has fluctuated a lot. You can see pretty clear cycles, but what I find most interesting about this is that the unemployment rate ticks up just slightly before the beginning of a recession usually. So here you can see it ticked up slightly before the gray line, that's the recession. Here, not so much, a little bit more muted, but then here you can see, again, right before the gray line ticks up a little bit, right before the gray line ticks up a little bit. As we look through history, you can see that right here. You can see that right here, and you can definitely see that in the early 2000s as well as the financial crisis here. So I wanted to point this out that unemployment tends to tick up, and we have not seen that yet. We're going to get into the recent data here soon, but I wanted to point that out first. One of the biggest factors feeding into the unemployment rate obviously is initial claims. So after coming in low during the last few weeks, the initial jobless claims broke through a key 200,000 level over the last few weeks. So the week ending April 1st, we got initial claims at 228,000, while claims from prior weeks were revised up over 200,000. So from these data points, again, the 4-week average has moved up on an upward trend since January. So that's definitely a good sign if you're bearish on the employment market, bad if you're going to be losing your job. But overall, we want to see unemployment come up a little bit to tamper down on inflation. In this chart here, you can see where the initially reported claims are in that red line, while the jobless claims after adjustment, after revision, are in that black line. Typically, we've been seeing that it comes down after revision. You can see that here, or it's generally pretty close to where the jobless data is initially. Here you can see it's revised down from the initial data, but here we've been seeing a period of upward revision where the initial jobless claims data is much lower than expected, and then it gets revised up in later weeks. So this is good in terms of the Fed tampering down on inflation, getting the labor market under control, but definitely something important we wanted to note here. Another chart I think showed this really well was the insured unemployment of this week of the initial claims data. So here you can see as of March 25th that since about October, we've been in an upward trend of insured unemployment. So again, not great if you are in that category of unemployed, but overall good for the economy that it's cooling off, and hopefully the Fed can pause on their rate hikes pretty soon. Looking past the initial claims data that we get every week was the March jobs report that we got on this Good Friday while the markets were closed. So we saw a continually strong labor market with non-farm payrolls up 236,000 in March, which was just a little bit higher than expectations. And we also saw average hourly earnings grow about 4.2% on an annual basis, which was slightly under market expectations. The most important part of the March jobs report, though, is the unemployment rate. So we saw the unemployment rate in March fall unexpectedly low to a really slim 3.5%, which was down about 10 basis points from February's 3.6%. Not a huge move, but really historically low unemployment as initial claims starts to tick up, and as interestingly enough, layoffs have been in the news for a few months here. So we haven't been feeling that yet in the unemployment rate, and we're really looking forward to the market digesting this information next week, as this key economic data rarely falls on market holidays. So we haven't seen how the market is reacting to it yet, but it'll be interesting to see next week. This week, we saw a really eventful week with employment data coming in at a strong 3.5%, unemployment rate really low, as the U.S. added about 236,000 jobs in March. We saw initial claims tick up slightly, and we also saw a slowdown in both the manufacturing and services industries. As always, though, regardless of where economic data is pointing, each of our portfolios, we're constantly monitoring, we're constantly using these economic updates to best manage each of our portfolios per their mandate and per their nature to best take care of you. Thank you for tuning in to our market update this week, and we look forward to providing another update very soon.